Since the financial crisis of the late 2000s, the global financial market has been slowly recovering. Over more than 10 years of increasingly digital globalization, the integration of global markets, and the streamlining of digital commerce. For example, international banking has experienced drastic drops in cross-border flows of financial capital and less investment into foreign banks than prior to the crisis. However, even though the vast majority of this capital withheld from foreign investment was from developed countries, developing countries actually experienced growth in investing abroad, and the diversification into the financial sector in general to strengthen many of their economic portfolios. Mauritius, for example, has become an Indian Ocean hub for finance and trade. With few natural resources to offer in the global marketplace, its attention has been turned toward more digitally based and less extractive industry-based commerce and trade. With international partners like South Africa, France, India, and many other sub-Saharan African nations. International banking activities have the potential to improve the degree of competition in the local banking sector, help upgrade skills, and improve the efficiency of resource allocation, particularly through exercises in diversification and the direction of the financial sector itself into less volatile industries like IT, infrastructure, communication, and investments into long-term projects. Certain financial markets, which might be more loosely regulated, like those between developing countries in the global south, can additionally be kept more disciplined and in check with the added degrees of technological innovations designed to keep checks and balances between financial institutions in those countries. Combined with higher degrees of capital flow in general and the increased efficiencies thanks to technological diffusion and adoption, the general consensus is that this will contribute to faster economic development and greater financial stability. However, caution should also be exercised in opening international banking alliances, where openness can potentially introduce a higher degree of volatility and expose certain weaker financial institutions in developing countries with poor information, inadequate contract enforcement, and weak regulation and supervision to predation. Foreign banks may drive out domestic banks in these countries, but with the same policies as they carried out in their homeland, which can potentially reduce access to finance and financial inclusion, like in the case of Barclays Bank in East Africa. As a result, there is an important role for policy to play in these new emerging economies, in ensuring that the international banking activity occurs in ways which maximize stakeholder benefits, inclusion, investment into long-term projects, and the streamlining of financial transactions, while minimizing the risk of predation, manipulation, or dumping financial risk onto other weaker institutions. Specifically, from a policy perspective, drafting and enforcing legislation which commands good information sharing, property rights, contract enforcement, and strong regulation and supervision are key. These criteria must also be agreed upon between the parties involved as a part of the agreements themselves. This helps to prevent foreign banks with larger financial or legal clout from just displacing smaller-scale domestic banks and taking advantage of regulatory inadequacies or a lack of resources to carry out the litigation process if something goes awry. With stronger institutions emerging from such agreements, the playing field of competition is leveled, and competition between them can then go down market to smaller and smaller financial transactions, loans, savings, and trades, improving access and inclusivity for small businesses, households, even microloans through emerging financial instruments like mobile payments or for people without official bank accounts. In drafting such legislation, it's important to bear in mind the cultural differences of the financial institutions in question, often from differing countries with differing goals, levels of participation in the global financial market, varying degrees of volatility in the worth of their currency, interest rates, size, perceptions of time, and societal norms. Taking stability into account for financial policy, the risk-sharing costs and benefits of globalization must also be considered. For example, actual brick-and-mortar banks still tend to be less risky or volatile in terms of banking for the end user than cross-border financial flows in international transaction making, like in investment into foreign currency. Developing country finance in the global south and the financial interactions between these countries are expected to see increased degrees of development and competition. However, in contrast to the comparable degrees of competition and development in industrialized and financially fortified nation states, like many of those in the global north, South-South financial competition possesses the industry advantage of being able to capitalize on knowledge that Southern banks have regarding the institutions and culture of other developing countries. As a result, South-South strategies in finance tend to be better at targeting smaller and less well-represented markets, like small-scale agriculture households in developing countries, as well as the added degree of commitment from becoming more culturally institutionalized by those using their financial services. However, the shocks of global economic activity that occur elsewhere in the world, but which leave these southern developing states in places of advanced volatility, often limit the risk-sharing willingness of other financial institutions from, say, developed countries in the global north to form partnerships or adequately invest in innovation and development. In turn, South-South banking with one another has in fact been one of the primary risk reduction strategies in the absence of sufficient global North participation. Bill Reddy, the executive vice president and chief operating officer at PayPal, finds 4 major trends that are affecting the world of finance today. Number 1, the ways in which work is performed online are expanding and diversifying exponentially. And consequently, the ways in which workers, employees, financiers, freelancers, contractors, companies, and a slew of other economy participants get paid must diversify and expand to keep up with the financial tools demanded by these industry players. According to Reddy, over 90% of net employment growth from 2005 to 2015 in the US was in the alternative work category, which means that nearly all of the 10 million jobs created between 2005 and 2015 in the US were not traditional 9-to-5 jobs. People are increasingly likely to earn an income through online platforms. Online payment systems, like PayPal, can provide workers with many financial benefits, including better resilience to cover expenses, even if their main income source is lost. Number 2, automation, machine learning, and AI will displace certain current jobs typically manned by humans, and we will simultaneously experience some increased degrees of turbulence in payment and employee retention. To keep up with automation, more workers will require more advanced training, as well as increased access to credit and savings schemes. In fact, it's estimated that 40% of the world's jobs could be automated within the next 15 years. Number 3, entrepreneurs and small businesses will need more efficient, quick, and reliable access to capital for investment, more accurate management tools for finances and accounting, and sleeker access routes to credit for debt financing projects and businesses. Every year, an increased number of individuals are turning to more entrepreneurially minded activities for employment, like starting their own businesses or becoming freelancers. However, one study found that less than half of small business owners interviewed actually reported making consistent income each month, and over half the participants admitted to paying bills late as a result of less consistent income. Over 3/4 of all the participants in the study said that they would prefer receiving their income more frequently, even in smaller denominations, which requires technological financial solutions to come into play, such as Funds Now, which allows for immediate access to funds once the workday is completed, compared to the bi-weekly paycheck norm. Number 4, the fourth major trend in finance is a greater demand in flexibility in the workplace, with digital tools and remote management software becoming the preferred method of completing work and managing finances. Roughly 1/3 of millennials have more than one job. Yet with increased degrees of both flexibility and volatility, as the job market moves more toward project-based and on-call types of work, which can be completed digitally and remotely. Such flexible and inconsistent working arrangements will require more agile and non-traditional financial management tools, financing tools, and payment tools to meet the overlapping schedules of multiple jobs performed at more flexible hours remotely. The Group of Seven, or G7, is an international intergovernmental economic organization consisting of the 7 largest advanced economies in the world. The members of G7 are Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States, which meet annually to discuss matters of global trade, finance, geopolitics, and other major world issues. This year, the G7 summit convened in France and covered topics such as global trade, global warming, and taxing technology companies like social media enterprises. Environmental issues were discussed in length, such as French President Emmanuel Macron urging the G7 to begin the summit discussions with the 2019 Amazon wildfires, which he described as an international crisis. Nevertheless, among a myriad of discussions, debate, and challenging topics, 5 major points were agreed upon at the summit this year. Number 1, the World Trade Organization, with regard to intellectual property protection, has agreed to settle disputes more swiftly and to eliminate unfair trade practices. Number 2, the G7 has committed to reaching an agreement in 2020 to simplify regulatory barriers and modernize international taxation within the framework of the Organization for Economic Cooperation and Development, or OECD. Number 3, the G7 agreed to ensure that Iran never acquires nuclear weapons and to foster peace and stability in the region. Number 4, with regard to Libya, the G7 will support a truce in Libya that will lead to a long-term ceasefire and calls for a well-prepared international conference to bring together all the stakeholders and regional actors relevant to this conflict. Number 5, with regard to the ongoing Russian occupation of the Ukraine, France and Germany will organize a Normandy format summit in the coming weeks to achieve tangible results. Economic crises have been shown to alter the course of the cyclical nature of socio-metabolic cycles, which characterize how humans interact with the natural world with regard to energy and material flows and industrialism. The financial crisis of the late 2000s was no exception, meaning that how we use resources, do business, trade globally, and address ecological and social needs under business-as-usual scenarios may no longer be considered sustainable. One could almost consider the financial crisis an opportunity, as we now face a choice regarding where to move next. Some may search for alternatives to predatory capitalism and financialization, as well as the very metrics by which we measure progress. Mentioned above, investments into energy, communications, and transportation often indicate the beginning of a new long-wave economic cycle. For example, according to Smith, Vaser, and Harrison, we will be seeing an annual increase in transportation infrastructure investment by 5% per annum for the next 10 years, with sub-Saharan Africa leading the way at over 11%. Additionally, the Asia-Pacific region still possesses the most impressive transport infrastructure market, with investments increasing from $557 billion per annum to almost $900 billion per annum in the next decade. Through literature on the neoliberally guided previous 3 decades of economic growth, particularly in Anglo-Saxon countries like the United Kingdom and United States, it has been made clear that emphasizing short-term financial thinking, unbounded resource extraction, the privatization of the commons, the commodification of nature, and an ever-widening wage gap cannot continue without serious consequences. This loosely regulated arrangement of the global economy encourages unhealthy over-competition at the expense of the have-nots and the financialization of the global economy. Financialization, here, is used to describe a situation in which the financial industry holds the most weight over any other industry in an economy. Short-term gains are sought, various industries are invested in, both domestically and internationally, with the financial industry as the medium to do so, yet mostly on a lending basis for profit-seeking rather than dividend-seeking ends. Then, bonds, loans, mortgages, and a number of other financial instruments are then sold if the holder deems it may reach a higher value in the near future. The idea is to buy low, sell high, all without tangible cash, rather than investing capital into long-term, dividend-seeking projects like infrastructure or energy. Instead, like Song and Hiwaki argue, what may be required to happen is a multiplication of the number of economic models and policies, the decentralization of power, regional economic growth, fairer allocation of resources, and long-term productive capital being invested into initiatives that will improve social well-being and protect the interests of the natural environment simultaneously. Companies aimed at doing so through promoting income inequality, microfinancing, and economic access and inclusion have created an entirely new industry through these initiatives, often referred to as fintech, a combination of finance and technology, which aims to use technology and innovative business models within financial services. Traditional banks will continue to play a significant role in the global financial service market, but fintech companies, with their ability to adapt quickly and use technology to lower costs and provide novel credit analysis systems, are increasingly serious disruptors of the heavily entrenched business-as-usual financial industry. In summation, today, the challenge is to create a robust, inclusive financial system which people trust and does not prey on the weak or global poor. Global trade, hand in hand with global finance, and all intermediary instruments like savings, investments, and other financial products are essential for long-term growth, non-growth and development, and equal participation in the global trade arena. People all over the world who wish to conduct trade require reliable, affordable financial services, and it's up to the innovative capabilities of a growing number of countries to meet the specific needs of digital commerce, remote workers, part-time workers, small-scale farmers, informal bankers, and a slew of other players who need adequate financial services for their lifestyles and livelihoods.